The US stock market is in focus recently, first due to the AI bubble jitters. Now it has fallen again. On October 20, Wall Street was on a roller coaster. At the end, it erased nearly $2.7 trillion in value. This came despite Nvidia calmed the AI bubble jitters from the minds of investors by actually releasing better than expected earnings and guidance for the next quarter. This initially boosted the tech sector and the tech-heavy Nasdaq index. Nvidia's shares had surged 5% and other tech-heavy stocks also started rising. All was good, looked like the markets were actually coming back on track, and then the enthusiasm faded and caution gripped all over the markets. Later in the day, Nvidia's stock had reversed sharply, closing 3.2% lower. This decline also weighed on semiconductor stocks broadly, with corresponding pullbacks in technology names like Oracle and AMD. The swift erosion in confidence exposed the fragility beneath what was seen as an AI-driven rally. At the center of this fall was the mixed US jobs report for September. The report was supposed to be released early, but the US government shutdown had actually delayed key economic indicators, and the report, though, showed payroll additions above the expectations at 119,000 new jobs, suggesting resilience in the job market. So why did the markets fall then? Well, the unemployment rate, though, was also rising. It ticked above 4.4%, its highest levels in 4 years. So while the jobs were increasing, the unemployment rate was also rising. This mixed signal raised doubts about Federal Reserve's December interest rate decision. Many investors had hoped for clearer signals on whether the Fed would cut rates to support growth, but the data had actually created more confusion. As a result, the market's implied probability of a rate cut fell below 40%. Treasury yields also softened, with 10-year note yields dropping about 4.1% as fixed income markets were also digesting the economic data. The tech sell-off extended beyond Wall Street to crypto markets as well. Bitcoin fell 4.2% to about $86,337. This environment of uncertainty contributed to heightened volatility. The CBOE Volatility Index, Wall Street's fear gauge, surged to its highest level since April, reflecting increased anxiety. Intraday swings were also dramatic, with Nasdaq seeing the most extreme move since earlier tariff-related turbulence in April. Semiconductor indices also plunged nearly 5%, underscoring the sell-off's focus on tech hardware closely tied to the AI enthusiasm. Defensive sectors such as consumer staples outperformed modestly, with Walmart posting strong quarterly sales driven by e-commerce growth, signaling continued consumer spending strength despite lingering inflation pressures. Looking ahead, the markets remain highly sensitive to forthcoming economic releases and Federal Reserve's communications on interest rates. The path of inflation, labor market trends, and fiscal policy will actually shape investor sentiment and market direction in the next few days.
If you like this video, then like, share and subscribe to ET Now.